The Ensombl podcast is intended for professional financial advisors. This content is created in partnership with our sponsor, Morningstar IM, ABN 54071808501, AFSL 228986, Challenger Investment Management, ABN 29092382842, AFSL 234678. And is limited to publicly available information. Before acting on any general advice, you should consider whether appropriate and obtain financial advice from a qualified financial advisor. Ensombl does not hold an AFS license and does not provide any financial advice or services or endorse any general advice. If a PDS or IM exists, you should obtain a copy and review it thoroughly before making a decision.
How are you now? And welcome to the Ensombl Investment Podcast. My name is James Whelan, VFS Group Investment Manager, and I'm here to represent you, the humble advisor, doing their best to walk the line between client interests and asset class selection. We're trying to find the things that are not only appropriate, but that are actually working to be in the right things at the right weight for the right clients. So get set, because myself and Morningstar are going to do our absolute best to answer some of the questions that have come up over the Ensombl platform. All information contained is general in nature. So here we go.
Morningstar Investment Management Australia is delighted to be sponsoring Ensombl's investment podcast series, designed to equip advisors to have more meaningful conversations with clients. Morningstar Investment Management is a global leader in asset allocation, investment research and portfolio construction. Specialising in investing, behavioural coaching and practice optimisation, Morningstar strives to give advisors the tools to confidently navigate their clients' complex needs. Morningstar, empowering investor success. Challenger Investment Management Fixed Income is a specialist in public and private credit markets. The business dates back to 2005 and as of the 31st of December 2023 is managing $15.9 billion across a range of strategies focused on generating consistent income whilst minimising capital volatility. The team takes a value-based approach to credit investing with a focus on demanding an appropriate return premium for credit and liquidity risk.
How are you now? And welcome to the Ensombl Investment Podcast, brought to you by Morningstar. My name is James Whelan, Managing Director, Barclay Pearce Capital's Wealth Management Team, and I'm here to represent you, the humble advisor, doing their best to walk the line between client interests and asset class selection. We're trying to find the things that are not only appropriate, but also that work, and maybe try and find the right time to be the right weight for the right clients, that holy trilogy. So get set, because myself and Morningstar are going to do our best to answer some of the questions that have come up on the Ensombl platform, and obviously all information contained is general in nature. I've never managed to get that right. All generals in nature. Oh, don't worry. Anyway, carrying on. It's said that if you have a really bad person in your life, that you should lend them $50 and you'll never see them again. Sound advice for life, but amazingly, not a great investment case. In our world, you probably need to see that $50 again, probably with a little bit of interest back as well. But who do you lend to, for how long, and at what rate? Now, that's a very simplistic way of putting it. We're going to get a little bit more complex than that. There is the question about how long and at what rate and how much to put into. To help us discover more and to answer the listener questions that you have put in through the Ensombl platform, to keep them coming, we've engaged the expertise of some of the finest minds in finance. Ameya Hattangadi, got it right, CFA, Associate Portfolio Manager at Morningstar Investment Management Australia. Ameya, how are you now?
Very good, thank you, James. How are you?
Oh, fantastic! You can hear the buzz in my voice, can't you? It's sensational. There's a real buzz around the city today. It's just an incredible time to be alive and awake and investing. And joining us from Challenger Investment Management, it's Pete Robinson, Head of Investment Strategy Fixed Income. Pete is responsible for Challenger Investment Management's multi-strategy credit portfolios, including the Challenger IM Credit Income Fund, Challenger IM Multi-Sector Private Lending Fund, and Challenger IM Private Lending Opportunities Fund. The hard work that I've done cutting and pasting off the website is really paying off there. So, Pete, how are you now?
Well, I'm great. Thanks for having me, James.
Yeah, that's all right. Was all that still correct?
All spot on. Spot on.
No worries at all. Now, everyone gets asked the same question, Pete. You're not going to get excused at all. It does provide some good context for the discussion as we go on. What do you do, and how do you make money?
Yeah, so I really, the way I summarize it is I look at the plumbing of the financial system. That's really my job. I look for where there are opportunities for us to provide capital, and that capital comes in the form of loans, where other providers of that debt are not providing it in an efficient manner. So really what we're doing in Australia, in the Australian context, is looking for ways in which we can provide more tailored or bespoke capital to borrowers that the banks can't. And that's really principally my job within Challenger Investment Management.
Okay. And I'm sure that you're amazing at it. And I've been told that you actually are quite good at what you do too, which is fantastic. Ameya, this is the first time that you and I have been on a podcast together.
Correct.
Do you want to run us through what you're up to at Morningstar?
Yeah,
And then we'll talk a little bit about the economy.
100%. So at Morningstar, our main focus is multi-asset investing with a valuation bias. So we look at all sorts of asset classes, equities, property, credit, of course, fixed income, and through the lens of valuation, through this lens of long-term investing and looking for value where assets are underpriced. At a high level, that's kind of what we do. We play, I guess, the market all over the world globally. And our main focus, of course, as I mentioned, is kind of trying to find some of those assets that are underpriced and really make the most of those opportunities.
Good. Excellent. And thank you again for joining us here as well and for helping me manage the podcast too, which is great. So feel free to chip in any time. Now, the funny thing is that since I became the head of a wealth management team, the irony is that I am now so far disconnected from what's actually going on in the financial markets world. I'm hoping that you can help me. What are you seeing out there? Generally speaking, what are you seeing out there in the markets? Without giving any too specific a time frame on exactly what it is, but how's it looking out there from your end, Pete?
Yeah, look, I think, there's an old saying in markets that we're all rates investors. Everything we trade is off the basis of interest rates. Valuation models are all based on where interest rates are. So we can't have a conversation about where we are today without talking about interest rates.
Yep.
And I think really we're in a bit of a pig in the python moment. So the pig is still in the python. It's slowly being digested. And when I say the pig, I mean this higher interest rate environment. So we've really had a regime shift in the last 24 months where we've gone from an environment of very, very low, unsustainably low interest rates, and those interest rates have moved higher. And I think there's a lot of focus right now on directionality. So does the RBA hike? Do they cut? Without as much focus on, how long rates will be in the current range. The reality is even a 3% cash rate is going to be problematic for some asset classes. And so what we're waiting to see is how long rates will be elevated and how much pressure that will put on the wider economy.
What sort of do you have a general idea of where you think that's going to go? Do you have a view on that?
Yeah, we think the bias is that rates will stay elevated for longer.
Locally, we're talking locally here.
Talking locally, yeah. But I think, we're all interconnected. I think if we go back, if we look at the US, Powell back in 2018 really seemed to have a bias towards quantitative tightening and keeping and moving rates higher, and he moved them higher quite quickly.
Yeah, he should.
Had to pull back because markets reacted to that, but kind of showed his hand in our view. And all the rhetoric I think coming right now from central bankers is that they want to be cautious. They still think that there's risks to the upside around inflation. We saw that from the RBA statement yesterday around, the upside risks around inflation. So we think rates will be elevated for longer. That doesn't mean we won't see a cut this year. We just think the cuts won't be as sharp as perhaps has been priced by the market. And in fact, in the last quarter, we've really seen a repricing of that with about one cut sort of taken out that was previously priced. If we look at where we were at the start of the year, one cut's come out. And we think potentially further cuts are delayed.
Now, what I want to do, Pete, I'm going to put a little pin on that and just say that and I'm going to come back to you with the question of what happens when there is a repricing in the expectation of cuts and what that then means for credit, specifically the private credit. We'll get to that in a sec. So save that one up. Ameya, what are you seeing out there?
Well, at the moment, I think I'd echo a lot of the comments made just then about how we've seen almost like a regime shift over the last 24 months or so. And I think at the moment, at least when you look at fixed income markets, broadly speaking, we see yield levels roundabout fairish. So we're not really seeing bonds as being especially attractive. And if you then go over to the other side and talk about equities as well, I think there are some risks there. Obviously, we've seen some very dramatic moves, particularly in the US market. You think about Magnificent Seven and so on. We've seen some massive moves there. So there are these spots which are maybe a little bit elevated and a little bit expensive. But on the flip side, you also are seeing some opportunities, particularly in the emerging market space, where there is some value. So it's a challenging market. There's, of course, a lot of uncertainties. And I think a lot of assets are so closely linked to what central banks are doing, to what the rhetoric is, to what the expectations are for interest rates, as you just mentioned, and everything is tied to that. Equities, fixed income, property as well.
Now, is it just me? This is sort of more of a general holistic sort of question, but is it just me, or is it definitely since COVID hit, maybe even before, actually probably going back to the GFC, do you think that central banks have always had as much front row center attention continually as they do, and they continue to do so now? Do you think that there'll be a time when we don't hear every single day from every single member of the Fed and it broadcasts, that they can just go and speak at a university and it's not a market moving instant?
It's a great question, James. I think if we go back 20 years, we had Greenspan still at the helm, and every word, every movement of an eyebrow was watched,
There's those little
intently.
pauses, wasn't it?
By the market. So I don't know that the focus has changed. I think, at times I've felt that the Fed and central banks globally have focused too much on trying to message to the market to get a reaction. And, I don't know that that's played out exactly as they would have liked to. And certainly the RBA's experience around, their communications during COVID was problematic. And we've seen RBA reforms which have actually, in some ways increased the transparency. They're having the meeting with journalists and researchers post the RBA minutes being released, but at the same time, they've also reduced the frequency of the meetings. So they are trying to find a balance.
Finish, and then I'm going to keep peppering you about the other.
I guess I'm not sure whether there's going to be any change in the scrutiny. We're all trading in information, and so I don't know that that's going to change necessarily, but they might pull back from sort of too much signalling with an intent to create a price reaction
and just do it. Yeah, that would be it. Now, without crossing the line of having too much of an opinion on things, how do you feel about the new RBA structure, the new governor as well? There was a bit of a rocky start in that first press conference. I think it was a bit funny that a lot of Taylor Swift being converted about that.
I think it's still very, very early days. From our position in terms of the way that we invest, we don't take directional views on the RBA, and really we're focused on the medium term, outlook, and what, I referred to the pig of the python before, and really that's about, a view that rates will stay somewhat elevated for longer, and that the effects of that will take time to pass through the real economy. And so what we're looking at is, what does that mean for credit risk more generally across the economy? So I feel like I've kind of evaded that question.
Oh, you've done that nicely. That's wonderful. It's all right. Yeah,
I'm sure I might have some views on that. I can throw the hospital past to him.
There is a new. I know the Morningstar could probably have more of a view on this, being sort of in that space. I know that certain my fund manager mates and my economist mates, what they say in private, they're just like, this cannot ever be repeated anywhere else. Sometimes it's positive, sometimes it's not, but it just can't be too aggressively in one way or the other.
Yeah.
What's your view on the new RBA structure? Is it better for the common man? I'm all about the common man. Better for the advisory services?
I like, my personal view is probably no. I don't think it's going to be any worse either.
Yeah.
I just feel that it's not going to have much of an impact really either way on markets, and also on the common man, as you said, like the individual out there.
All right.
I just feel that Michelle Bullock's come in with a specific mandate to implement all the outcome of the report, the inquiry a little while back. And that's pretty much it. Like, she's going to come in and try and tighten things up. But I think in terms of actual monetary policy and what they do to, or rather their reaction function with respect to inflation, employment, and the macro situation, is unlikely to change.
Okay, well said. All right, now let's just get into some of these questions, and then I will wheel back as part of what we're doing. We'll talk about the effect of pricing of forward cuts or raises to how it affects credit. We'll get to that at the end. Now, this is good for me because actually, of all of the asset classes that we cover doing this podcast series, this is one that I've actually never touched. So it's just never come up, and that's just sort of the side that I've always just sort of been in a retail sense. Can you explain to us what private credit actually is and how it works? I mean, this is let's really break it down just to not too simple, but just sort of to imagine you're talking to someone who's been in investment services for 17, 18 years.
Yeah, so I think the best way to describe what private credit is by telling you what it isn't. So it's everything that's not public credit. So you can almost think of it as it's a loan that you're making to a borrower. So you're charging a rate of interest, and you're hopefully, if you do your job right, you're getting repaid the principal that you've lent back at maturity in the same way that you would with a bond, in the same way that a bank lends money. But you're not doing it intermediated through a bank, so you're directly finding the borrower to lend to, and you're not going through an investment bank effectively who might package the transaction into a bond. And when you get packaged transactions, you get external credit ratings, you get often it's to listed companies, so there's a lot of information that's available about the company that you're lending money to. There's a lot of price discovery as well, because there's multiple investors participating in the transaction. Often in a private deal, you're lending to a private company. There's no external due diligence information available. There's no credit ratings available. There's no documentation underlying the loan. You have to put that together yourself. And for that, you charge a higher rate of interest. And that's in a nutshell what we think private credit is.
So in effect, that you guys at Challenger IM are, without being too product specific, obviously, but you're the ones that are actually out negotiating those deals directly with,
absolutely, yeah,
in many cases, individuals, families, owners of not families asking for a second level on their house. I mean, sort of like a serious family.
Yeah. The vast bulk of what private lenders do would be dealing with private equity sponsors.
Yep.
So these may well have been family-owned businesses, but they've been acquired by a private equity business who then is seeking financing to support their acquisition. So it's acquisition-backed lending. It may also be asset-backed lending. So we may be lending against pools of receivables, whether they're residential mortgages, credit cards, personal loans, anything like that have been originated by a non-bank lending business.
Okay.
We can also lend against commercial real estate, and often that's owned by private individuals, or it may be owned by private equity.
Yep.
So it's a whole gamut of opportunities that are out there, but the key part of it is that the deals are private, they're directly negotiated, and yeah, we have to go out and find them.
That's what I was about to ask, how you source those deals. I don't mind going out and hustling for a day, but I can imagine there'd be pretty big, like it doesn't just get presented to you.
Yeah, absolutely. I think, hustling for a day is a degree. We do that to a certain degree, but we've been doing it for 20 years. And so, you do get some momentum in the business from that. So a lot of the relationships that we've had for many, many years, and through the global financial crisis, which is really beneficial. But it comes through the sponsors, the private equity sponsors I talked to before, advisors to those institutions, whether they're investment banks or auditors, legal firms, accounting firms. There's a whole range of introductions, even other businesses that we've lent to sometimes provide introductions to us. So the key is being in the business for a long period of time, having scale of capital so people know that you can come and provide a solution to them, and dealing with people appropriately. That's not to say you bend over to give them exactly what they want, but you behave commercially and appropriately through transactions, and there's long-standing and well-established relationships that come from that.
Good answer. Thanks, Pete. So, okay, so I know what it is, where it sits now. Where does it sit in a portfolio, Ameya?
Yeah, interesting question.
You're the PM guy, so you're just, you're the allocation guy.
We were internally just having a chat about this not too long ago, about whether private credit is fixed income as an asset class or whether it's alternatives as an asset class.
Yes.
And I think the jury's still out on where it sits. Some would argue that it's alternative, like it's not traditional fixed income like a bond, government bond, or so on, so it should fit in alternatives. But on the other hand, you can also argue that because you're getting a consistent income and capital stability, it is pretty much like a bond, so perhaps it should sit in fixed income.
Yeah.
But either way, I think what you're getting from private credit is something quite unique from a multi-asset portfolio construction perspective. There's lots of benefits, and we can get into that.
Yeah, go straight into the benefits. That's actually that's the third question. I'm holding the second question.
Yeah.
Go to the third question. Just go any of the benefits that you've got. Well, we'll talk upside, talk downside. I mean, there's always give and take in this market.
Yeah. So, like, for example, in terms of the benefits, I think the key things that we look at from a fixed income allocation, if you like, whether it's bonds or private credit, is income, capital stability, and diversification from equities and liquidity. So as a general rule, I think there's 4 things that we look at. From private credit, I guess one of the things that you're not really getting is liquidity because there's no active market as such for private credit. Maybe there's a little bit of liquidity at the end of the each loan, but by and large, there's no real liquidity as such. You still get diversification. I mean, partly it's a function of the fact that it isn't priced very often. So, for example, you might get monthly pricing. And so as a result of that, you just don't see that much volatility at all compared to any other asset class.
Okay.
And you're getting, so capital stability again. And the last one, of course, I think, which is a key component of any sort of fixed income exposure, is income, where you're getting a consistent, stable, contractual income from your investment.
Can you confirm that, Pete? Is it stable? Does it stay a fairly straight line?
The only caveat to that I'd say is that it's largely floating rate. So with the movements in the cash rate, you will see movements in the overall level of income that's provided by the asset class. But it's paying, when we say fixed income, it's paying a fixed margin above the base rate.
Yeah, and so this is, I mean, again, not specific to the area, but is it because the deals that are made with the other parties, is it because they're floating rate deals and that's why it changes like that? Dumb question.
It's a great question. I think some of it comes to the genesis of the private lending market, which it really came out of the bank lending market. And if you think about banks, they've always been variable rate lenders. So the bulk of the lending that they do is variable rate. And so that's flowed into the lending markets on the private side as well.
That's why it passes through. Okay.
Yeah, and it's not to say that all the lending isn't floating rate. Like, so there are fixed rate deals out there. Sometimes you see it on the commercial real estate side. And when you have a set of sort of really stable cash flows that you can lend against, you can fix them. Another factor is that the loans are generally prepayable. And so one of the things about private markets and alternatives, and Ameya, you talked about it from an asset allocation perspective. I think about, us as providing an alternative to the banks and the public bond market in our private lending activities. Yep. And we charge a high rate of interest to provide that alternative. And so borrowers typically don't want to pay that higher interest rate for a longer period of time. So typically we're lending to them to provide, we might provide speed of execution. So they might want to acquire a business and we help them do that. They might be going through a transitional event. So think about an office that's, 70, 80% occupied and has to spend some CapEx to upgrade the building to get new tenants in. We might lend them through that transitional event.
Yep.
And we charge for that risk. And the loans are prepayable because the borrowers typically want to pay that loan back and get, a bank loan or go to the bond markets where they can get cheaper debt. If it's fixed rate, it's harder to do that, because if I've provided a fixed rate loan for 5 or 7 years, and they want to prepay it after, 2 or 3, I'll typically want to make whole. And so that's another reason why some of these loans are generally floating rate.
Okay, that's good answer. And that does explain why it carries through as a floating rate on the actual product itself. Now, Ameya, you mentioned the benefits of private credit. Let's talk about some of the risks.
Yeah, definitely. From our perspective as multi-asset portfolio managers, I think one of the key risks, and which is also kind of a benefit, is the lack of liquidity.
Yep.
Right. So, for example, as I mentioned earlier, when you kind of want this diversification, so when, for example, equity markets might sell off, you would look to fixed income or cash, for example, to provide that negative diversification, but also you want the optionality to then be able to sell it and then reinvest in equities at lower prices.
Yep.
But in the case of private credit, because it doesn't have that liquidity as such, it's a bit harder to do it. So you might have to go elsewhere.
Okay.
So you really have to think about how to size your private credit exposure in a multi-asset portfolio just so that you don't maybe have too much of an exposure to illiquid assets.
Yeah, I've got one of the sort of marks here that's coming off the Ensombl platform of someone that's mentioned it. Reliability of valuations is a question mark that's there. Now, how, generally speaking, how do you value a thing? Do you just send a guy out and have a look at it and that's your value? Like, I actually know one of those guys who works at Macquarie Bank. He is the sharpest mind that I've ever seen with saying he can look at a building and say, yeah, that's worth 17 million. Do you have those guys that are out there doing that sort of thing?
Yeah, certainly whenever we make a loan secured against a real asset, that the underlying valuation of that asset is a critical input. We'll set covenants around that valuation and we'll get that valuation regularly refreshed. I think when it comes to marking to market, though, our approach is somewhat different. So we don't hold things at par. So we do think that there's volatility in the asset class.
Okay.
Risk premiums in markets move around.
Yeah.
As you were saying, Ameya, around equity markets, like you want to reflect in your valuations the underlying risk of the investments. And so we will, on a monthly basis, refresh valuations across all the private loans that we have in our portfolios. We're lucky in terms of the scale of our business. We've got an independent credit risk team. They rate all of our deals. And off the back of that rating, we've got a valuation process that feeds from that.
Yep.
And so we'll see shifts in valuations. So if you think about a commercial real estate asset, the input to that is that security valuation that your esteemed colleague or friend at Macquarie is providing the valuation for. So we'll get that refreshed, and let's say the valuation on that asset declines sharply. You know, we might have been at a 65% LVR, the valuation comes down and we're at an 80 LVR.
Yep.
So first thing that will happen is we'll breach covenants, but we'll also downgrade the investment. And as a result of that downgrade, that'll result in a change in the valuation of the underlying loan that we've provided, because that loan is inherently more risky.
Yep. So that's at 80 LVR, that's where it triggers. That's the usual area that everyone has a thing.
Look, every deal in private markets, every deal is different, because what you're trying to do is provide a solution to a borrower that's very tailored to their needs. If they wanted just a general standard out of the box loan, they'd go to a bank. The banks can provide, those types of things. What we're typically doing is providing them a loan that's meeting their specific requirements. So we may have a covenant, we may lend at a 60 or 65 LVR, we may have a covenant at 70, but have that step down through time, because the business is saying, well, we're going to, in that example I referred to earlier, we're going to release the asset, that, occupancy is going to go up, our interest coverage is going to go up, the valuation on the asset is going to go up because the rental yield's improved. And so as a result of that, we'll say, okay, well, we'll step our covenant down through time to adjust for that as well.
Well, that makes sense. Thanks. This is fascinating stuff, actually, getting the mechanics of how this little piece of the world that I've not had much to do with actually works. Let's talk about correlation. Where does this sit? Like, what does it go against, or what does it go with in a correlation sense?
Well, it's not really correlated with anything.
That's the best thing.
Yeah.
Right.
It doesn't get better than none.
Yeah.
But that's the benefit of it, right? Like, in a way, that's kind of what you want from an asset class.
You want to have
when you're building.
You want to have some things that are in there that don't move all together at once.
Exactly.
Yeah.
You've got your equities or bond markets going up and down, and then you've got an asset on the side that doesn't zig or zag when your equity or bond markets zig and zag.
Yeah.
Right? So it just kind of hums along and does its thing.
Okay, so now I'm going to come around to the question, Pete, about let's just take, for example, in the US. Can I use the US market as the example?
Sure.
So the US market, there's theoretically three interest rate cuts that have been predicted for the rest of 2024. And they're potentially saying that now there's only going to be two. So that short repricing, which doesn't seem like much, 25 basis points here and there over the long term, not maybe sort of comes in and out of the wash. How does that then affect what you do?
Yeah,
if at all.
This is such a great question. APRA's got a huge amount of focus on valuations, because I think our take is probably that there is a bit of a correlation with growth assets within private,
okay.
Because we do mark to market. So we do change our valuations with changing market conditions. But the key thing, I think, is how quickly do we change it? How how reactive are we to public market conditions? And I think what you'll find is certainly on the equity side, I've heard the argument that, private equity or private infrastructure or property valuations didn't go up as much as public valuations when times were good. So we didn't, in the private markets maybe reflect the decline in interest rates to the same degree as maybe public markets did. And certainly if you look at superannuation funds, a number of them will say in their valuation models they use a smoothed average over time of, the long-term interest rate when it comes to, valuing some of their assets. And so that will be reflected on the way out as well. And so, 25 basis points additional, in cuts in a short period of time won't really change their valuations that much.
Yeah.
But if it persists over time, that's where you'll start to see the valuation impact coming through. And that comes back to this pig in the python thing. It's just going to take time for this higher interest rate, this regime shift that we've gone through to really pass through the economy and certainly to pass through the private markets. And so when we're looking at it, when we're looking at the US or Australia, we're really thinking about how long our interest rate's going to stay in this sort of 3 to 4.5% type territory.
Yeah.
And what does that mean for the borrowers that we're lending to?
You guys have got a fair bit to do with the commercial property space, I'm assuming.
Look, it's not the largest part of our portfolio. We're probably distinct from a lot of the private lending market in Australia. I think about half of the private lending market in Australia is commercial real estate linked.
Yeah.
Largest exposure within our portfolios is corporate direct lending. So we're, cash flow backed lending to corporate Australia. We do a little bit of commercial real estate, but it's not construction lending. It's really more focused on, existing assets.
Yeah, well, it's funny because I was going to ask you about existing assets, sort of where you see that the direction traveling for that. I mean, the death of commercial real estate has been called a few times over the last year and a half, 2 years, 3 years, actually probably now 4 years. So since COVID hit,
yeah.
Do you see it surviving or evening out or balancing out generally?
Yeah, look, I think there's certain parts of, if we talk commercial real estate, I think there's certain parts of the market that are performing really, really strongly. Student accommodation was something that was under incredible focus during COVID, and that's rebounded impressively. I think there's parts of the non-discretionary retail space that are doing pretty well. Obviously, logistics is something that's performed really well. But then, on the other end of the spectrum, we have office, and particularly non-premium office is an asset that's really struggling. So if you look at vacancy rates, they are increasing. And I think the instructive thing that we're seeing from the US is that they're really bifurcated. So you have 20% vacancies in the US, but in some parts of the US, vacancies are a lot higher than that because you have some really tight markets as well.
Yeah.
And so the problem is from a lending landscape is if you've got exposure to an asset that's gone from 80% occupied to 50% and interest rates have gone up, your interest coverage on that loan is sub 1 times, and you're probably underwater from an LTV perspective as well. We've certainly seen that in the US. We haven't seen that as much in Australia. I don't think Australia is nearly as bad. We didn't go quite as far as the US, and interest rates haven't gone quite as high. But certainly that's an area that's under considerable focus from investors is that non-premium office space.
Yep, I concur 100%. Now, Ameya, there is a time and a place for everything. Now, generally speaking, that you have a portfolio that's allocated to assets and it keeps that same sort of that you're allocated in each one of those things. But it's all about the overweight and underweight, which is where you guys come in. When things are valued, when things are overvalued. When is the best time to be overweight this sort of space? That's a tricky question. I'm sorry, I've put you on the spot with that one.
Yeah, it's a tricky question. I guess what we've seen over the last couple of years is an environment where cash rates have shot up 400 basis points, and you've seen traditional bond markets really sell off dramatically. And it's like in the US as well, it's probably we've had 2022 was
fun for all of us, mate.
Exactly.
Sorry, yeah.
But a market like private credit wasn't really impacted as much. So an example of when it might be a good time to get into something like this, or maybe be slightly overweight private credit, is if you think that cash rates are likely to rise.
Yeah.
But then I think you also have to consider why cash rates are rising. and what the impact might be of those high rates, as Peter's been mentioning, in terms of how it might impact valuations, how it might impact the underlying ability of these corporates or commercial real estate businesses to be able to repay those loans. So you've got to kind of factor all of it in. But in terms of at a high level, like a portfolio level, you might want to be going overweight something like this if you were to expect cash rates to push up.
Well, okay, and it's always a good test of the integrity of a fund manager as to the answer to this question. When is a good time to be overweight this particular sector? And you meet some guys just like all the time.
It's a great test. Well, look, certainly I think that within your SAA, there's a place for private credit. It's hard to do tactically. Like I'll admit that.
Oh, for sure. Yeah.
But one of the things I think that happens with private assets generally is they tend to lag public markets. So they lag on the way up and they lag on the way down. I run a bunch of strategies that invest in both public and private credit markets. And so if I think the relativities around the two, actually 2022 was kind of a good time to be in public markets because they sold off so much and so they were cheap.
Yeah.
And that doesn't happen most of the time. When markets are not volatile, private assets are a good place because you can earn that illiquidity premium. But when markets sell off, what tends to happen is private markets stop trading. Illiquid markets become more illiquid. So when times are volatile, I think the opportunity is much more in public markets.
That's a fantastic answer. Now, I've got two inflammatory statements that have come. Full disclosure, these have come off the website, so I'm going to read them, and we'll just open up the open slather for conversation about these ones. Okay, this one isn't that inflammatory. This is from an Ensombl. We should put names next to these things, Kieran. What do you reckon? I want to. No, maybe not. Yeah, okay. There are. This is the question, or this is the statement. There are significant advantages to private credit: higher yield, no mark-to-market risk, no duration risk. Arguably, they fulfill exactly what you want fixed income to do. They pay an attractive income and returns, brackets should, for well-run funds, end brackets, have zero correlation to growth assets, thus offsetting risk. Now, we've sort of covered some of these things before, but responses to that? Agree? Confirm? Half agree? Part agree?
I'd say I part agree with that. I think, certainly there's higher income available through a cycle within private assets. But as I said earlier, I do think that there is correlation with growth assets. I think if growth assets underperform, if you think about equity valuations declining broadly across the market, then, the credit risk of, investments that rank senior to the equity has increased. And so there should be some correlation. We typically guide people to around 60% correlation with growth assets.
Okay.
The thing I'd call out, though, is the diversification benefit. So at an individual asset level, you're not getting overlap with your existing portfolio. So if you think about what's in the ASX 200, financials, infrastructure, utilities, you're going to be able to increase the industry diversification by going into private markets. You're not going to get a lot of exposure to banks and financials through that. And so, by the nature of that, at an idiosyncratic level, you can really add diversification.
Yeah. Anything from you?
I kind of agree with a lot of it, but also on some aspects, I'm a little bit skeptical because I feel like the main risk for us is lack of liquidity. And I feel when you're managing money day to day and all other asset classes are mark to market, it's kind of important to have something there that's sized appropriately that you can still rely on. Yeah. So one of the angles that one of the ways that we use private credit is almost to have a structural allocation to it, an allocation that we're unlikely to change whether equity markets sell off or whether they rally.
It's always going to be there.
Yeah, it's just going to be there. It's just going to deliver the returns.
If equity markets really sell off, then all of a sudden that size gets a bit bigger, as I think sometimes.
Yeah, and you don't want to risk it being too big and becoming a part of your portfolio that's illiquid. You can't trade, and it's just a big part of what your assets.
Is that accurate with regards to the liquidity, Pete?
Yeah, I'd say certainly day-to-day liquidity is not available in private credit. That's absolutely true. If I go back about 10 years, the conversations I was having with the big superannuation funds were, I only have this amount of illiquidity budget, and why wouldn't I do private equity versus private debt? And it was very much in that nature of like, I've got a binary view of liquidity. Either it's liquid or it's illiquid. And I think what we've seen from institutional investors is they've become a bit more nuanced in that view. The reality is, if you think about a loan, the best liquidity is a maturity of that loan, a refinancing. You get all your principal back.
Yep.
And so if you have a diversified portfolio of private loans, they're typically very short dated. We always tell people follow the KISS principle, keep it short, stupid. So keep your lending short, you get refinance. And so there's natural liquidity that's created through the portfolio. So across our portfolios, about 25% of the portfolio a year it matures or is repaid.
So what was the duration on it?
So the when we call duration, this is my pedantic background, but
go on.
The credit duration of our portfolios is about 1.5 years. The interest rate duration is about zero because it's floating rate.
It's floating rate, yeah.
So it's pretty short dated, and that's what the borrowers want because, as I said earlier, they're paying a higher interest rate for some convenience factor that they're not going to need forever.
Brilliant.
So we typically do find that it does create liquidity, but certainly in those brief periods of market volatility, if you think about COVID, your private credit portfolio wasn't a source of liquidity in March of 2020.
All right. Well, okay, last inflammatory statement and then we can get a beer. Like any fund, you need to do your homework on the manager. Experience, process, resources, auditor, quality of the loan book, costs. Transparency is important. The critical questions are, of course, the level of security, reliability of valuations, and diversification of the loan book. It's going to be difficult for you to not talk about your own specific book there, but is there any response to that one, Pete?
100% agree.
Yeah,
absolutely. Like the asset class itself lacks in transparency. There's no one independent to me telling you about the quality of the portfolio. So it's a real challenge I appreciate for investors to go into the asset class and bridge that sort of agency risk. So really understanding the manager, understanding their track record, their process for valuing assets, their processes for assessing the credit risk. So you can get comfortable that the strategy is generating a 10% yield, but not taking an overly outsized, amount of credit risk to achieve that, is really critical. And so, deep due diligence with managers. We wrote a piece, which is up on our website called 21 Questions That You Should Ask Your Private Lending Manager. We added 5 questions to that post-COVID. And so, these are the questions we think are really important for people to get to the bottom of what the manager's doing, why it's doing, and any risks associated with that.
We'll see if we can link that up through the Ensombl page. Now, Morningstar has the ability to do most of that due diligence work, I believe.
Yes.
Says me very leadingly into the Morningstar person who's here to talk about it.
Yeah, definitely. So Morningstar has different divisions.
Yeah.
So the fund research team would be doing that sort of due diligence.
Yeah.
Where they'll go in and look at the processes that the managers use, how they value assets, how they do their due diligence on the different businesses that they're going to lend to. But on our side, on the investment management side, we can lean on them for that research. Like if we're thinking about investing in a private credit manager, then we'll speak to the manager research guys and try and understand them better. But we'll also do our own due diligence when we decide to invest with the manager, and we'll go and do the same things that they kind of do.
Excellent. Well, I think that we've managed to get through the questions that we have. We managed to know what it is, where it sits, when to be doing what with it, where it serves the purpose of it. And so I think that we can call this a pretty successful podcast, fellas. Yes? Do we concur?
100%.
You concur. Good. Now, thank you for joining us. Ameya Hattangadi, Associate Portfolio Manager at Morningstar Investment Management Australia. Thank you so much for joining us.
Thank you very much, James.
And Pete Robinson, Head of Investment Strategy, Fixed Income at Challenger Investment Management. Thank you very much.
Thanks, James.
All right, that's it. I am James Whelan, Managing Director of Barclay Pearce Capital's Wealth Management Team. Our producer, Kieran. As always, fantastic to have you around. And thanks for listening.